Right, guys. Um, you now have got a little bit of information or like a brief introduction to what charting is. We know a chart is a price representation of a financial instrument. We've talked a little bit about candles and how a candle represents the price movement over a period. So opening price, a closing price, and a high and a low. So what I want to talk to you about now is shorting the market. In other words, the ability to enter in a position and make money when the price of a financial instrument goes down. Okay, so if we look at here, Telkom, here in this trend, the price of Telkom went down up to the point down here on the 1st of November, and then it went up. So general logic is if you buy a bag of potatoes, you own the bag of potatoes, and a month later you sell the bag of potatoes at a higher price, then you've made money. The price of an asset needs to increase, the value of it needs to increase for you to make money, right? So how is it possible to make money if the value of an asset decreases? It just doesn't make sense. How does that work? And the beauty is that makes that work is called future contracts, single stock futures and indexes. What is that? Well, historically, you took your money, you went to a brokerage, and you purchased a share from, let's say, Telkom. They will issue you a share certificate, which proves that you own a certain percentage of that physical share, of that company. Right? It is yours. It belongs to you. But then, with the dawn of electronics, computers, and all of the stock market going online, they were able to create something that's called a futures contract. And I'm not going to go into the in-depth technical details about future contracts and how they work. I just want you to understand holistically what that is and how does that enable us to be able to short the market or go long in the market. All right? Because everything that we're going to do is going to be within the future contracts. So a brokerage, all of them connect together, can create these future contracts. They list these future contracts. It's tradable by traders across the planet via the brokerages, via the exchanges. The future contract is still a representation of the underlying asset. So in other words, if you open the future contract, as we did here for Telkom SA, it's still the representation of that asset. It is a graph of the physical asset. So if you would have purchased a physical share certificate, you would have looked at the same graph because it would have had the same price representation. Okay, cool. How single stock futures work is as follows. You go to a brokerage. The brokerage, and I'm gonna simplify this, all right? So if you Google it, then I'm going to talk about baskets full of shares. But GT247 says, yes, Mr. Marbeck, you want to trade Telkom anytime. We will sell you a Telkom share. We will not sell you. We will borrow you a Telkom share. And we have Telkom shares in our little basket. For you to be able to trade the price movement, you need a physical share. You don't have enough money to buy it. I don't have 5,000 Rand. I've got 1,000 Rand. But so I can't buy a physical share. I can't get a fair share. But I still want to trade the price movement of Telkom. So they say, we will borrow you this share, all right? So here they borrow you the share, and they say, for borrowing the share, it's going to cost you X amount in commissions. That commission is calculated by the brokerage themselves. It's normally an X percentage of the value of the asset. Okay, so that's the brokerage fee that they ask you. That's how they make their money. Okay, so now you've got this share. So now I want to short the market. How does it work? I've got the share. I think the market is going to go down. All right. I've borrowed one Telkom share from Global Trader. Via this system, when I click sell or short, I borrowed the share from GT247 and instantaneously via this electronic system, some schmuck in the world thinks that the market is going to go up. That person wants to buy the Telkom future contract. So in that case, I borrowed it from Global Trader. I now resell that to some other person. on the future contract market with the arrangement that at some future date, I will buy it back from him. That person thinks the market is going to go up. I'm saying the market is going to go down. And true as Bob, the market is going down, 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 down. And at some stage in this downward trend, I go and says, all right, I think this is far enough. I'm going to buy the contract that I've sold back. So I buy the contract back at a lower price. So I sold it at a higher, I borrowed it from GT247 with the agreement that I will return it. I sell it to some schmuck on the internet via the system that thinks the trade is going to go higher. The trade goes down, 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 and I eventually then goes, okay, I'm buying the trade back. So I'm buying a telecom contract from whoever in the world wants to sell it again. So I buy it back at a lower price. So now I've made profit. I go back to GT247. I say, thank you very much. It's in conclusion of our contract that we had. I am returning your telecom share. And that is a short position. That's how we're able to short a market via future contracts. Okay? One thing you need to understand is the following. No, we're not purchasing at the full price. In other words, Global Trader is not going to go and say to you, you need 5,000 Rand, 5,200 Rand to borrow one share from us. They're going to say to you, you need a commission price. That's how much it's going to cost you per share to borrow. But then there's something called a margin, right? What is a margin? The margin is Global Trader or your brokerage is going to say, you need to have X amount of money in your account. Why do you need X amount of money in your account? You need that amount of money in your account to protect them against the movement of the share. So I borrow the share from them and the share price goes down. If the share price goes down and I then return it back to them, I'm returning them an asset that's worth less than in the beginning. So they've now lost because the value of that asset that they borrow to you is now less. That amount of money will go against your margin if you were in a long position. Okay, so if you borrowed it from them and for a long position, the market moves against you and you return it, that amount of money would have been deducted off your margin call. Margins on different instruments are different in size. For instance, a margin on Dow Jones for one Dow Jones is 124 Rand. If you want to buy one LC, it's 1,200. If you want to buy one Bitcoin future contract, it's 4,500. And that margin size is calculated based on the volatility of the instrument. For instance, Bitcoin can move 5% up and down literally within minutes, hours. Dow Jones moves 5 or 10% in months, if not more. So the volatility of a Dow Jones is much, much less than that of a Bitcoin. Hence, the calculation and the risk management from the brokerage is going to be significantly more for Bitcoin. Hence, you need 4,500 Rand per Bitcoin in your account to protect it compared to a Dow Jones future contract for which they're going to ask you 124 Rand to have in your account. All right? So that in essence is as simple as it gets. That's how we short sell. That's how we are able to short a market, enter into a share as if we have purchased a share, telecom, oil, gold, forex, what have you, but not pay the full amount of the listed price. If we go to something like an Aussie, for instance, Aussie currently is 51,709 Rand. So if you would have purchased one Aussie, that's what it would have cost you. Naspers, I think, is sitting at something ridiculous. And you can go to some of these instruments and you'll see what the current listed trading prices are. All right, guys, that's a video just to give you an indication of historically buying a share, getting a share certificate. Then there's future contracts, which is a contract position where you literally borrow a share, in inverted commas, from a brokerage, resell it via the system, and return that share as per the future contracts stipulations. And that enables us to literally be able to trade price movement without having to go through the rigorous process of buying shares, share certificates, etc., which by the time you've done that, the trade is over. Any questions? Give me a shout.